Alright, for this video I want to go over the IRS Form 1099-C, which is a cancellation of debt reporting statement that's provided to you and the IRS. And so I want to go over this statement and then also cover how you can exclude cancellation of debt income from your earnings. So I have a 1099-C in front of us that we'll go through, and then we also have a Form 982, which is what you include with your Form 1040 to report the cancellation of debt income and how you exclude it from your earnings. So I've got those two pieces in front of us. I also have an insolvency worksheet. So the insolvency worksheet is going to be prepared by this taxpayer to where they can figure out whether or not they are insolvent and they can exclude the cancellation of debt income from their earnings. And then in addition to those three pieces, I do have one slide covering some background on the 1099-C and the 982 and then go into the fact pattern in a little bit more detail. And then I do have an Excel workbook here, which we're going to use alongside the insolvency worksheet to figure out what our insolvency amount is and how we allocate the reduction of basis to our personal property when we exclude that income. So I want to start with this one slide here first, and then we'll go to the 1099-C and the insolvency workbook and worksheet, and then we'll get into the return itself. So 1099-C, so what is this form? When is it filed? It's filed by the creditor, right? So if you have a credit card company or an auto loan company or a bank, if they forgive a debt, right, so cancel a debt, either full cancellation or a partial one, the amount of debt that's forgiven or canceled is reported on this 1099-C. It goes to the IRS and you get a copy. So if we look at this example here, let's say a taxpayer buys a car for $30,000 and they put $3,000 down in cash, so they borrowed the difference, right, $27,000. Now after a few years, if the taxpayer loses their job and they can't make the payments anymore, the car is now worth $18,000. But they owe the bank $22,000. The bank takes the car back, sells it, applies the balance against the note, and so there's $4,000 left that the taxpayer owes to the bank, and the bank decides to forgive that amount. So the bank will report the $4,000 of forgiven debt on a 1099-C. Now, when you have forgiven debts, the general rule is that is included in gross income. So under Section 61A, gross income includes the amounts discharged, the amount of discharge of indebtedness, right? So when you have a balance on a loan forgiven, that's going to be income to you. Now, this is where we get into the insolvency or the bankruptcy exception. So you can exclude canceled debt amounts from income if you, as a taxpayer, are insolvent, or you had the debts just discharged during bankruptcy. So during a Title 11 bankruptcy proceeding, you can generally have those debts not only forgiven, but they're not included in income. Now, not always the case, right? In some cases, certain debts can't be discharged during bankruptcy. Some have to be included in income. But for the most part, you can get them excluded from your earnings. You just have to file the Form 982. Now, if we look at the insolvency exception, which is what we're going to have with this example, you need to complete an insolvency worksheet. Now, the worksheet's not filed with the IRS, so you do it on your own behalf, keep it from your records. But you can find this insolvency worksheet, which is what we're going to look at in the IRS publication 4681. All right. Now, if you can manage to have any debts excluded, it's not exactly a free lunch, right? So if you can exclude the amount of debt discharged from income, you have to reduce certain tax attributes. So things like net operating loss carryforwards, capital loss carryforwards, general business credits, or the basis in your personal property. And so that's the example that we're going to have here. So let's look at our example here. So we have John taxpayer is a single filing taxpayer in Florida, and he has credit card debt of $9,500. Now, the credit card company forgives the balance owed. So the credit card company issues him a 1099-C, and John goes ahead and completes the insolvency worksheet and determines that he's insolvent to the amount of $6,340. So What that means is his liabilities exceed the fair market value of his assets by $6,340. All right, so that's the amount that he's going to be able to exclude from income, and the remaining has to be included. And so the reason for this, again, is this bullet point up here. The amount of debt that you're excluding from income can exceed the amount of your insolvency. So even though he had $9,500 in debts canceled, you can't exclude all of it. Sometimes you could, right? If his liabilities far exceeded $9,500, the difference there, then he might be able to manage to exclude all of it. But in this case, when we look at the worksheet, he's only going to be able to exclude a portion of it. And then the amount that is excluded has to reduce the basis in his personal property. All right, so let's take a look at the 1099-C, and then we'll get into the insolvency worksheet here. All right, so this is a 1099-C. You can see it's issued for calendar year 2020, and it's coming from this credit card company. It's issued to John as a debtor, and it is credit card debt in box 4 for the description. Now, the amount of debt discharged is the $9,500 amount, and it includes accrued and unpaid interest of $1,745. Now, John is going to use this to prepare his tax return, the 982 specifically as well. So if you look at his insolvency worksheet, this is where, actually, let's look at the tax return first. So if I go to Schedule 1, this is where you would report cancellation of debt income. So if John was doing his tax return and he didn't have the insolvency exclusion, if he wasn't doing this through a bankruptcy, if it wasn't qualified personal residence debt, right? If there was no exclusion, then the total amount of cancellation of debts would be included in income on Schedule 1. So on line 8C here, we can see there is a cancellation of debt line item. Now, you'll notice that that's not the full $9,500, right? Because John is going to claim an insolvency exception. But if you were in the scenario where you couldn't get an exclusion, you would just report all of that 1099-C here on 8C. But John, again, is going to get an exclusion. So what does he need to do? We have an insolvency worksheet here. Has to be completed. Highly recommended. Because, again, this is not sent to the IRS, but you have to keep it for your records, one, to determine whether or not you are, in fact, insolvent. But in the event the IRS ever does audit you or challenge the position, you want to be able to provide this information. So the insolvency worksheet is completed just before the debts are forgiven. So you include the amount of debt that was actually canceled. So Part 1 here, we list the total liabilities immediately before the cancellation. So we can see here we have credit card debt on line 1. He does have a car, so he's got an outstanding loan on that, $23,600. And he does have some student loans, right? So he's got $12K left on his student loans. When we look at the assets section, you report the fair market value of all assets owned immediately before the cancellation. So he's got his checking account there, $1,000, $1,060. The fair market value of his car, $24K. Computers, household goods, and furnishing. So John rents, right? So he only has a few furniture pieces that he bought for his place. So not a large number there, only $400. Jewelry, watches, things like that. He's got $3,000 worth. His clothing, books, $300. He has an IRA, traditional IRA, retirement account, $3,500. Security deposits with his landlord, right? So again, he is renting, so he has $1,000 in the security deposit. So when we total up the total fair market value of his assets and then subtract the two, we can see that his insolvency is $6,340. So remember, insolvency is the excess of your liabilities over your assets. And so John has done this worksheet, and he's also done it in this Excel workbook too. And so this will be important when we go through the 982 because, again, if you're excluding an amount from income, you have to reduce certain tax attributes. So again, capital loss carryovers, passive activity loss carryovers, NOLs, general business credits, things like that. But if you don't have any of those, then you reduce the basis in your personal property. So we have the FMV here on this column, right? And this is the same as the insolvency worksheet, but then I have a second column here for his actual basis. So what he paid for in the assets. So the car, for example, right? He paid $28,500, but now it's only worth $24,000, right? Right, common, right? So computer paid $1,200, now it's only worth $500, and that's because most of the time when we purchase assets that are of personal use, they don't appreciate in value; they depreciate, right? Okay, so I'll come back to this when we talk about the allocation of the reduction in basis. But if I go back to the tax form, so we have our insolvency worksheet here. Now, again, remember when we talk about the amount that can be excluded, it can't exceed the amount to which, the extent to which you're insolvent. So John is insolvent to the amount of $6,340, and that's it. So that's the total amount that he could exclude from the canceled debt of $9,500. So the 982, pretty straightforward in that there's not a lot of fields to complete. So in part one, we're checking this second box here, right? We have a discharge of indebtedness to the extent insolvent, not a Title 11 case. So Title 11 meaning bankruptcy. So he hasn't declared bankruptcy, he's just insolvent. So we've checked that box there. And then on line 2, the total amount of debt that's being excluded from income is $6,340. Remember, the total amount that was canceled is $9,500, but he cannot exclude all of that from income because he's not insolvent to that full amount, right? It's capped at $6,340. So once he completes these two fields up here, part 2 is the reduction of the tax attributes. So line 10A is where we report the reduction in basis of non-depreciable and depreciable property, right? So the $6,340, how did we come up with that number there? This is where it gets a little tricky, right? So the amount reported on line 10A, this last bullet point here, the basis in our personal property is reduced to the lesser of. So it's the smaller of three numbers. Now, in most cases, it is the amount of debt that was discharged and excluded from income, but not always the case. So it's the smaller of the three numbers. Remember that. So the basis in personal property at the beginning of the next year. So if this is 2022, what's the basis in our personal property at the start of 2023? Well, if we look at his insolvency worksheet, he does have a lot of assets going into the end of the year. So the basis in his personal property is $47,410. Now, this is as of the cancellation date, which was in October. But you can see the point here, right? You're trying to add up all the assets that you still have at the start of the next year, and do you have sufficient basis to exceed that cancellation of debt income? And $47,000 is significantly higher than the $6,300. So that's the first one. That's the first number. The second number is the amount of debt that's being excluded from income. So that's $6,340, or the excess of your total basis of property and money, so cash included, after the cancellation over those total liabilities. So again, it goes back to kind of an insolvency computation, right? So what's the total basis of your property plus cash, plus the IRAs, all of that, over your total debts, and that's the third number. So based on John's profile, the number that's the lower of the three is bullet point 2 here, right? The amount of debt that's excluded from income. So when John does his part 2, line 10A, he's going to use the amount of discharged debt excluded from income as the figure to reduce the basis in his property. All right. So I'll come back to that, but now what do we do with the amount that's actually included in income? So again, once you have that amount excluded, the amount that needs to be included in income is the difference. So $9,500 minus the $6,340 is $3,160. That's that figure there. So this piece is actually being subject to tax, and then the difference there is excluded from income. Now, once you have the amount that you need to reduce your basis in property, it is allocated across personal property in proportion to that asset's value of the total. So that's why I have these pieces here highlighted. So we have cash, IRA, the security deposit. there's not going to be an allocation of basis to these items because they're not considered personal property for these purposes, right? So the things that are those tangible assets. So we have the car, computer, household furniture, the jewelry and the watches, clothing, books. And so this 6340 is the total amount excluded, and then we are allocating the reduction to each asset based on its fair market or its basis percentage of the total. So if the total is this added up, which is $41,850, what percentage is the $2,800 of the car to the total? And that's how we're allocating this amount. So each of these should sum up to the total amount excluded, right? And that's why we have the 6340. So I've just done an Excel formula here, which basically takes this asset divided by the total times the amount of excluded, and we round it out just to make it nice and even and clean, and that's how we get our allocation. Now this is important because, one, you have to personally track this, because if at a later date, let's say John decides to sell his computer, right? Let's say he sells his computer. Well, his basis is $1,200, but because he has had to allocate a reduction, he has to reduce his basis by 182, so it's down to 1018. And in effect, what that means is if John sold it for, let's say, if John sold it for $1,200 again, right? So he bought it for $1,200, going to sell it for $1,200, he would actually have a taxable gain because he has reduced his basis to 1018, right? That's the point. So that's, again, there's never a free lunch with the IRS. So even though you can exclude the amount from your income, you have to reduce your basis in these personal assets. And if at a later date you sell them, well, now you have an adjusted basis, so you could potentially have a gain, all right? Now, once all this work is done, you're supposed to include a schedule with your tax return that shows the allocation. So we've got Form 982 attachment here that's going with the IRS. We've listed out the personal property asset. So we have vehicle, computer, household furniture, jewelry, clothing, books, the original basis, and then the basis reduction that's allocated to each. And so as long as John does all of these pieces, and again, the insolvency worksheet, you know, the IRS, again, they don't want that, right? They want you to keep that for your records, but it's important that you do it to make sure you are, in fact, insolvent. Otherwise, you can't take advantage of this exclusion. So that covers it for this video. I hope that was helpful. If you have any questions, please feel free to leave me a comment below, and I look forward to seeing you again on the next video. Thank you.